Hello and welcome to this week's stock analysis. Last week we looked at PPG Industries, and today I would like to take a look at National Oilwell Varco, which has the ticker symbol NOV, and it was suggested to me by one of my listeners with the nickname Smurf Kitsa. So thank you for suggesting this stock to me, because I think, as I said, National Oilwell Varco. We're here at gurufocus.com. It's a website with a lot of financial data. I really like to use it. So let's go there and look at it. And as the name suggests, it's an oil company. It's in the oil industry. Actually, if we look at another website, which is over here, I think I showed this last week, fool.com. The company is a worldwide provider of equipment and components used in the oil and gas drilling, production operations, oilfield service, supply chain integration, and to the upstream oil and gas industry. Well, what you see here is this interesting graph, because this is a 6-month graph, and the blue line is the company, National Oilwell Varco, and you see that it has plummeted in price, and the same cannot be said of the S&P, because it actually went up a couple of percentage points during those past 6 months. So what's going on is has to do with the oil price, and here we are at the website of Nasdaq.com, and we have a 6-month graph of the crude oil price, and as you can see, it went from, well, let's say $103 to $75 in 6 months. So, and it seems to be still declining. I mean, there's no way to tell if it will decline further, and I'm not going to speculate about that either, but there's definitely this has definitely had a tremendous impact on the price of National Oilwell Varco. And so the interesting question is this a fundamental problem? So is it reasonable that the price has dropped, or is this maybe this drop in price maybe offers us as a value investors an opportunity to purchase this stock at this depressed price? Actually, one thing I wanted to say about this drop in oil price, I mean, I heard a lot of speculation about it, and one of the reasons people say that the price is dropping, and I think it's an interesting theory at least, I'm not sure if it's true, is that the United States tries to sort of pressure, puts economic pressure on Russia by lowering their oil price, because Russia depends on incomes from oil a lot. So to hurt them, not with weapons, but with in their wallet, the US tries to ramp up their oil production, and that way sort of depresses the oil price. Not sure if this is true, but it's an interesting theory at least. So let's have a look at National Oilwell Varco. Oh, I dislike this a lot. Okay, so this is the summary overview on gurufocus.com. You can see scores are quite alright, the financial strength, etc. Profitability and growth seems to be alright. But yeah, as I also do in my other videos, I try to not go on these predetermined metrics, but always use my own spreadsheet, my value spreadsheet. So let's log in. As you can see, welcome, you can now use the spreadsheet. So we'll fill in the ticker symbol NOV and see what comes out, just to see how it's now loading the data, and it has loaded the data. So as you can see, this paints a slightly different picture than the Guru Focus, and we'll dive in a bit deeper to see why that is. For example, return on equity, it says it's bad. So why is it bad? Let's take a look at the inputs tab here, because there we see some here's the return on equity. Well, it says it's bad because we actually want to look for companies that have above average profitability. They shouldn't just be profitable and consistently profitable, but also have above average profitability. and Warren Buffett sort of defined this as around 15% or higher, return on equity of 15% or higher, and as you can see, it's around 11 or 12, which is not too bad, I have to say, but it's not amazing either. But okay, it's all right. So let's take a look at any of the other things that are red flags. The net margin, for example. Well, maybe we can take a look at a graph for that. Let us see if it wants to load. Yes. So net profit margin, as you can see, it swings up and down. It went down during the last, as I can tell from this, 1, 2, 3 years in a row, which is not a good sign. The general trend is still upward, but yeah, as you can see, the net margin is going down, and that probably has to do with the oil price as well. Book value is increasing nicely. That's a good sign. That means, it generally means that the company is creating value, which is what we want to see. It's actually making money and growing the value of the entire business. But okay, let's take a look at some other metrics. It says that the current ratio is good. I always think that's a very important metric. It tells you if a company is able to meet its short-term obligations, and they are. So it says that accrual profit is unsustainable. That has to do with the financial health tab of the spreadsheet. Take a look. Yeah, so what we see is that defensive profits, it's actually sort of similar to free cash flow, and accrual profit is similar to net income. And what you want is that net income is higher, or sorry, is in line with in line or lower than the free cash flow that's coming in, because earnings are based. If there's no cash flow, there can't be earnings, and if they do report higher earnings while they don't report healthy cash flows, that means that they might be manipulating their earnings. Well, the spreadsheet is giving a red flag, because as you can see, there's this big dip here, that the blue line is the free cash flow. So free cash flow has been, in one of these years, pretty low. So it's giving a red flag. It says if this continues, if the free cash flow continues to be lower than earnings, this is unsustainable. However, you see that it bounced up again, so you might reason that, oh well, they got it under control, so it's alright. Let's see, debt to equity is also an important metric to see how much debt they have with respect to the amount of equity they have, and it's very reasonable. They only have 1.15 or 0.15 debt to equity ratio, and you tend to look for a debt to equity ratio of 0.5 or lower, so it's actually pretty good. Now, what I can tell from all this is that the company is actually doing quite alright. It's in a healthy position. They don't have tremendous amounts of debt. Yes, their net margin is decreasing, which is definitely something to pay attention to, and they are not extremely profitable on a return on equity basis, but it's a decent company. Let's keep it at that. Now let's look at the valuation. As you can see, the spreadsheet includes 3 valuation models, and all 3 of them give very different results. So what can be causing this? For example, let's look at this lowest figure here, the return on equity valuation model. We take a look at the return on equity valuation. We see here how it calculates it. I explain this model and all the other models as well in my ebook, free ebook, how to value stocks. You can get it on my website, valuespreadsheet.com, or just send me an email at nick@valuespreadsheet.com. Yeah, so quickly, what we see here is that the sustainable growth rate is not very high. Well, if we look at the other models, we see that the growth rate they use here is a bit higher. So why is that? It's because the 3 models, I mean, calculating an intrinsic value is more an art than an science. So they all have their flaws. That's why we use several models simultaneously and try to and hope that the flaws balance out and you get a decent picture of where the value is. So for example, the discounted cash flow model and the price earnings valuation model, they use a growth rate which we get from Yahoo Finance. They pull all the analysts that cover the company, and these analysts then sort of give them an estimate of how much they think the company will grow each year for the coming 5 years. Well, that's the growth rate we use in this model and in the discount cash flow model. Then we take a little margin of safety, and then you get to this this growth rate, which is used in these models. However, the return on equity valuation model uses the sustainable growth rate, which is calculated based on the financial statements of the company, and so it has nothing to do with what analysts predict, and that's why it can differ. And in this case, it differs quite a lot, because this growth rate, the sustainable growth rate, is half as high as the growth rate that analysts predict. So that's why you see a massive discrepancy. Now the question is, how can we trust an estimate that is so far apart? Well, the answer is you really can't. So it makes it very difficult to put a value on this company. In a case like this, I would always err on the safe side, so I wouldn't go for this 120 figure. Here the average estimate of these three is 90, which seems much more reasonable, and if you look at it that way, you could say, well, it's undervalued by 26% at this moment, and if you would purchase it, you're at this current price of $71, you have an expected rate of return of 14% a year, which is decent. But again, it's not an amazing company, it's decent, and the valuations are far apart, so there's no way to tell if this estimate is correct in any way. So I wouldn't put my full trust in these figures, and I would personally look for an opportunity in the market where you can have more confidence in your analysis. And National Oilwell Varco is just not one of these great things that jump out at you and say, oh wow, I'm a great company and I'm selling at a very good price. Yeah, but the drop in oil price can definitely be an interesting factor at this moment, which you can use to maybe dig up some cheap companies in that sector at this point in time. But I wouldn't go for National Oilwell Varco, just because, not because it's a bad company, but because the figures, the analysis are just not, you can't put too much confidence in these figures because they are so far apart. Well, I hope you enjoyed this episode. If you want me to analyze a certain company next week, let me know in the comments, and thanks for listening. You can also download a PDF version of this analysis in the comments or in the description, on YouTube. So thank you for watching, and hope to see you next week.